This is the third analytical episode in this channel's archive, following Case File 06's examination of the hotel bankruptcy anatomy and Case File 061's examination of the private equity Grand Hotel acquisition playbook. This episode examines a specific category of real estate asset that this channel has called, across multiple case files, the trophy asset. The most architecturally significant, most historically prestigious, most culturally recognized properties in any given market, whose specific characteristics this episode formalizes into a single analytical framework. The Chrysler Building, the Plaza Hotel, the Ritz Paris, the Arizona Biltmore, the Sears Tower, Trump Tower, the Pan Am Building. Every one of these properties, documented in individual case files across this channel's archive, shares a specific structural characteristic that this episode names directly. The trophy asset premium creates a debt structure vulnerability that is the inverse of what conventional real estate risk analysis would predict. Conventional commercial real estate risk analysis assumes that higher quality, more prestigious assets carry lower risk, because their cultural and architectural significance provides a durable competitive advantage that protects the asset's income generation against market fluctuations that affect lower quality assets more severely. The trophy asset trap is the specific mechanism by which that assumption is inverted. The most prestigious properties consistently attract acquisition financing at premiums that exceed what the underlying operating performance can service, because the trophy asset's cultural and architectural significance generates acquisition interest from buyers whose investment thesis prioritizes prestige, acquisition over disciplined cash flow underwriting, producing debt structures whose service requirements are calibrated to the asset's reputation rather than to its demonstrated financial performance. The most prestigious properties are not safer investments. They are the investments most likely to be acquired at prices that exceed what disciplined underwriting would support, because the prestige itself becomes the underwriting justification. This episode formalizes that mechanism across the 8 specific case files this channel has documented, identifying the common structural pattern that connects properties whose individual stories appear, on the surface, to be entirely distinct. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The trophy asset trap operates through a specific 4-stage mechanism that this episode identifies across every documented case in this channel's archive. The first stage is the prestige premium formation. A property's architectural significance, historical importance, or cultural recognition generates a market valuation premium above what its operating cash flow alone would support. A premium that is genuine and persistent across multiple market cycles because the prestige itself is durable. The second stage is the acquisition financing miscalibration. Lenders and equity investors, observing the persistent prestige premium across multiple historical transactions, treat the premium as evidence of the asset's reduced risk profile rather than as evidence of a specific category of buyer demand, whose underwriting standards are less disciplined than conventional commercial real estate underwriting requires, producing acquisition financing structures whose debt service requirements are calibrated to the prestige-inclusive valuation rather than to the operating cash flow that would conventionally determine debt capacity. The third stage is the prestige cash flow divergence. The prestige premium, because it reflects cultural and architectural significance rather than operating performance, does not necessarily correlate with the operating cash flow growth that the acquisition debt structure requires, creating a structural gap between what the property is worth, including its prestige value, and what the property can generate in serviceable cash flow. The fourth stage is the covenant breach and resolution. The gap between debt service requirements and operating cash flow generation eventually produces covenant breach, triggering the same forbearance cycle, institutional denial, and eventual resolution mechanism that Case File 06U's analytical framework documents for conventional hotel bankruptcies, but with a specific complication that trophy assets introduce. The prestige value that justified the original acquisition premium persists through the financial distress, creating sustained acquisition interest from subsequent buyers whose underwriting may repeat the same miscalibration that produced the original distress. The covenant that conventional risk analysis does not adequately price is the one embedded in the relationship between prestige value, which is genuine and durable, and serviceable cash flow, which is the actual constraint on any debt structure's sustainability, regardless of how prestigious the underlying asset is. At what point does a property's prestige become a liability for risk assessment rather than an asset for risk mitigation? Leave your analysis in the comments below. The appraisal methodology that consistently produces the trophy asset trap's debt structure miscalibration reflects a specific category of valuation error that this episode's analytical framework formalizes across the 8 case file examples this channel has documented. Conventional income capitalization appraisal methodology projects stabilized net operating income and applies a capitalization rate reflecting the market's required return for an asset of the property's quality, location, and competitive position. For trophy assets, this methodology consistently produces a specific distortion. The capitalization rate applied to trophy assets is systematically compressed below what the asset's actual cash flow risk profile would justify, because appraisers and market participants observe that trophy assets have historically traded at premium valuations and interpret that historical trading pattern as evidence that the market assigns trophy assets a lower risk premium rather than as evidence that trophy asset transactions are systematically influenced by non-cash flow-based buyer motivations, prestige acquisition, institutional legacy building, and personal or corporate brand association that operate independently of conventional risk-return analysis. The capitalization rate compression that trophy assets receive is not, in this analytical framework's finding, evidence of genuinely lower risk. It is evidence of a systematically different buyer pool whose acquisition motivations are not fully captured by conventional cash flow-based valuation methodology, producing valuations and resulting debt structures that appear, by conventional underwriting standards, to reflect lower risk than the asset's actual cash flow volatility and serviceable debt capacity would support. The Chrysler Building case in Case File 0222, the Plaza Hotel's documented history, the Ritz Paris's resilience documented in Case File 052, and the Arizona Biltmore's recurring acquisition cycle documented in Case File 062, each independently document instances of this same capitalization rate compression mechanism applied across different property types, different decades, different geographic markets, and different specific financial structures, but reflecting the same underlying analytical error. The Ritz Paris case is the specific exception that validates this framework. Its resilience reflects an ownership structure whose time horizon and capital commitment were calibrated to the trophy asset's actual cash flow generation capacity rather than to a debt structure sized to the prestige premium, demonstrating that trophy assets can be successfully owned when the acquisition structure accounts for the prestige cash flow divergence rather than ignoring it. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The institutional denial embedded in the trophy asset trap is distributed across every participant in the acquisition financing chain, and its persistence across decades of documented trophy asset acquisition cycles, despite the recurring pattern's visibility in the public record, reflects a specific structural incentive misalignment that this episode's analytical framework identifies as systemic rather than individual. Lenders who finance trophy asset acquisitions at premium valuations benefit from the origination fees and the relationship value of participating in high-profile transactions, creating an institutional incentive to validate the prestige premium's risk-adjusted justification, regardless of whether the underlying cash flow analysis supports that justification. Buyers who acquire trophy assets at premium valuations are frequently motivated by considerations that extend beyond pure financial return. The institutional legacy value of owning a culturally significant property, the personal or corporate brand association benefits, and the specific psychological and social capital that trophy asset ownership provides within the buyer's professional and social community. Appraisers who value trophy assets for acquisition financing purposes face the same institutional incentive structure that Case File 060's analytical framework documents for conventional hotel appraisals. The appraiser's business relationship with the lender who commissions the appraisal creates an incentive to produce valuations that support deal completion, an incentive that is amplified for trophy assets because the high-profile nature of these transactions creates additional reputational and relationship value for appraisers who successfully support deal completion on prestigious properties. The specific institutional denial that recurs across every documented trophy asset case in this channel's archive is the collective failure to recognize that the historical pattern of trophy assets eventually finding buyers and being successfully refinanced or sold even after periods of financial distress reflects the durability of the prestige premium rather than the soundness of the original acquisition debt structure. Trophy assets do eventually recover from financial distress because their prestige value persists and eventually attracts new capital. That recovery pattern, observed across decades of trophy asset transaction history, is consistently misinterpreted by subsequent market participants as evidence that trophy asset acquisition debt structures are inherently sound, rather than as evidence that trophy assets are resilient enough to survive financial structures that would destroy less prestigious properties. A resilience whose existence does not validate the financial structures that periodically test it. The trophy asset trap's recurring pattern across this channel's documented case files, the Chrysler Building, the Plaza Hotel, the Arizona Biltmore, Trump Tower, the Pan Am Building, the Ritz Paris, and others, demonstrates a specific institutional learning failure. Each individual transaction's participants approach their specific trophy asset acquisition as a unique opportunity rather than as an instance of a well-documented historical pattern whose risks the broader commercial real estate finance industry has not systematically incorporated into its underwriting standards. The Ritz Paris case stands as the demonstrated alternative. A trophy asset ownership structure whose time horizon, capital commitment, and acquisition pricing discipline were calibrated to the property's actual cash flow generation capacity rather than to the prestige premium alone, producing a sustainable ownership relationship across a renovation cycle that other trophy assets' debt structures have not survived without distress. What the trophy asset trap reveals in the context of this channel's 68-case archive, as the third analytical episode in a sequence that began with Case File 060's Hotel Bankruptcy Anatomy and Case File 061's Private Equity Grand Hotel Playbook, is the specific structural vulnerability that connects properties whose individual stories, told in isolation, appear to be distinct narratives of management failure, market disruption, or institutional decline. They are not distinct narratives. They are instances of a single recurring pattern: prestige premium formation, acquisition financing miscalibration, prestige cash flow divergence, and covenant breach, repeated across decades, across property types, and across geographic markets, because the institutional incentive structures that produce the pattern's recurrence have not been systematically addressed by the commercial real estate finance industry's underwriting standards. The most prestigious properties in any market are not the safest investments. They are the investments most consistently mispriced by an acquisition financing system that treats prestige as a substitute for disciplined cash flow underwriting. If this case file changed how you evaluate the relationship between architectural prestige and real estate investment risk, subscribe, because the next case applies this trophy asset framework to a specific construction process failure that this channel has not yet examined. And in the comments, given the trophy asset trap's documented recurrence across 8 independent case files in this channel's archive, what specific underwriting standard modification would most effectively correct the capitalization rate compression that prestige premiums consistently produce? The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.